Hey everybody, Rob Maurer here. Welcome back to Tesla Daily. Today we are going to be talking about Tesla's 10Q filing, some new disclosures in there on their quarterly results. We've also got new pricing for the Model S and Model X, a new trim for the Model Y in Canada, some reporting on Tesla's market share, and more. Quick look at the stock. Tesla starting the week off today down 1.5% to close at $162.55, while the Nasdaq was down 0.3% on the day. The S&P and the Dow both up on the day. Looking at the calendar for the week, a couple of things to keep an eye on. On Thursday, there will be the first release for Q1 GDP. There will be two more. This is the advanced release, but our first insight into that report. And then on Friday, we get the PCE, or Personal Consumption Expenditures report. That'll be informative around inflation. And then Elon is also doing an interview on Friday, another one, this time on Real Time with Bill Maurer. Alright, getting into the news late last week, Tesla updating the prices for the Model S and the Model X in the United States, and actually not a price cut this time around, price increases for the S and the X, all versions going up by $2,500. Taking a look at this in our price change table, we now see that the Model S starts at $87,490 and the X $10,000 more at $97,490, both $5,000 more expensive than the introductory price following the refresh. However, alongside these price changes, Tesla is now also offering 3 years of free supercharging for customers who order and take delivery of an S or an X between the price increase and the end of the quarter. So margin-wise, that probably nets out strongly in favor of Tesla, the $2,500 versus the 3 years of free supercharging for a customer, case-by-case basis. But probably the most meaningful piece of this is that it does create a little bit of a sense of urgency for customers to order, to take delivery, whereas cutting the price, especially when we have seen that be consistent, maybe not as much of a factor in terms of creating that urgency. Tesla also playing with this benefit for current Model S and Model X owners that have free supercharging. Obviously, that can be an impediment to upgrading your vehicle. So Tesla is now offering 6 years of free unlimited supercharging for those owners who wish to either remove their unlimited free supercharging or trade in their vehicle that has it. So that can be a big perk to give up, but hopefully that'll help push people off the fence. They've got to consider, is it really worth it for those years that are beyond that 6-year time horizon to retain that free supercharging? That's a long time to assume you're going to be operating that same vehicle. So I think this should help pretty significantly for those customers, but obviously that is a fixed pool and you're only going to get so many of those people anyway. So some pretty interesting changes there for the S and the X. A little bit surprising given that we have seen inventory on the S and the X continue to remain at somewhat elevated levels, and obviously a little bit tougher delivery quarter last quarter. How much of that was logistical? We'll probably have a better idea of that at the end of this quarter. But based on the estimated delivery windows and available inventory, the order backlog in the S and the X, at least in the United States, does not appear to be much, if any. Internationally, I know there are still people waiting for their orders, have been for a long time, so different situation there. At the end of the day, it is all related. Now, the other big change to the design studio for Tesla over in Canada, they have added a rear-wheel drive Model Y. This is a shorter range vehicle than the long-range all-wheel drive. It's listed at $59,990, and the specs for the vehicle match up with the similar configuration that is available in China. With that being the case, not too surprisingly, Reuters today is reporting that these vehicles will be made in Shanghai, imported to Canada, and Reuters says, according to a production plan memo that they have seen, there is a target production of nearly 9,000 vehicles of this type for this quarter. Obviously, the more of those vehicles that are imported from China into Canada, the fewer that need to be supplied from the United States. That again adds more supply for the US, which will again put pressure on Tesla's pricing. So this could be related to the price changes that we saw in the Model Y last week. I think it provides a good example of how Tesla's prices are related even across region. If Tesla had higher demand at higher prices for those vehicles in China, obviously they would sell them there. And conversely, having the outlet for this vehicle supply allows Tesla to maintain a higher margin in China without inventory growing by that amount. Adding this lower price configuration for the Model Y in Canada also unlocks the Model Y for a $5,000 Canadian EV credit, which from how it's structured looks to apply to both this cheaper configuration as well as the all-wheel drive, more expensive version. So should be a couple of big wins there for Model Y volume in Canada. All right, next up, let's get into Tesla's 10Q for the first quarter. This is their quarterly filing that has a little bit more detail on their quarterly results. Always a number of interesting things to look at in this report, but it can be a little bit lengthy, so we'll hit the highlights on this. And since we were just talking about regional mix, we'll carry that forward. Tesla does disclose in their 10Qs the regional mix, so revenue breakdown for United States, China, and other. In the graph, you can see the United States in blue, China in red, and other in green. And then on the top right, I've also got the quarter-over-quarter breakdowns for the first quarter as well as year-over-year. So all markets were up year-over-year for Tesla in the first quarter, including China, up 5%. And interestingly, despite some of the pricing changes, Tesla did actually grow revenue in China quarter over quarter, up 7%. Obviously, deliveries were a record by 12 to 13%, but good to see revenue up as well despite the price cuts. The US and other markets were both down 6 and 7% respectively quarter over quarter, but they had bigger year-over-year increases at 29 and 34% respectively. Next in the 10Q, one of the things that seemed to get more media attention today was Tesla's capital expenditures guidance. This was slightly updated, I think a little bit overstated in terms of some of the reaction, but Tesla says, we currently expect our capital expenditures to be between $7 to $9 billion in 2023 and in each of the following 2 fiscal years. If we look back to last quarter, the 10K filing for Q4, Tesla said in that filing they expected 2023 to be between $6 and $8 billion, and then the following 2 years also $7 and $9 billion. So the only change here is a $1 billion increase for both the high and low ends of the 2023 range. Not too surprising considering Tesla spent over $2 billion already in the first quarter, but personally, as we talked about more on Thursday, I am totally fine and pleased to see that Tesla continues to spend aggressively on those future growth plans. Next, one of the things I had my eye out for in this filing particularly was what Tesla had to say about the Inflation Reduction Act. They didn't really talk about that on the earnings call this time around, so we don't know how that impacted the financials. We do get more detail on that in the filing. Tesla notes there are multiple incentives in the IRA to promote clean energy and vehicles, etc., and that there is also a new corporate alternative minimum tax of 15%, continuing on to say that some of these measures are expected to materially affect our consolidated financial statements. They say for the first quarter, the impact was primarily a reduction of Tesla's material costs. This is also brought up when Tesla talks about their automotive margins. They say that the average cost of their vehicles increased year over year due to increased pricing of raw materials, manufacturing, logistics, and warranty costs. So that's their explanation of the increase in cost of goods sold that happened year over year. But then they say the costs were partially offset by manufacturing credits earned as a part of the IRA during the 3 months ended March 31st. With this, we seem to now have an answer for how Tesla will be accounting for these manufacturing credits, which remember are separate from the consumer-facing credits, and it sounds like those will just be reducing what Tesla reports as cost of goods sold, and unfortunately that won't give us really much insight into how significant those credits are. Tesla CFO Zach Kirkhorn had previously said they expect that to be on the order of $150 to $250 million per quarter, and growing as the year continues. So in terms of margin, that's probably a benefit of just under 1 percentage point, maybe 80 basis points or so. But that did benefit Tesla this quarter, so margins would have been lower without those credits. As for the other business lines, Tesla says that for energy, they did have deferred revenue this quarter. That was $770 million. That's actually less than it was last quarter at 863, so it looks like they recognized some deferred revenue, probably just based on the billing sequence for energy storage projects. So we've talked about it before, but because of that, revenue for energy storage can be a little bit of a black box at times. A couple of other details on energy in general. Tesla says that energy generation and storage revenue grew primarily due to the increase in deployments of Megapack, higher solar and cash loan deployments at a higher average selling price, as well as an increase in deployments of Powerwall at higher average selling prices year over year. So good to see Powerwall also increasing, but probably at this point starting to be dwarfed by Megapack's volume. As far as energy margins, which did increase significantly year over year, Tesla noted that they benefited there from a higher mix of energy storage, which they say operated at a higher gross margin than energy generation. On services and other, Tesla talked about how they have benefited, as they have for the last few quarters, from an increase in revenue from used vehicle sales. Last couple of things on the 10Q, deferred revenue is always interesting to look at as there's a big number there for FSD, and also some things related to supercharging, over-the-air updates, etc. But that balance grew from $2.9 billion to just over $3 billion, and Tesla now says they expect to recognize $679 million of that in the next 12 months, which is up from $639 million last quarter. And then finally, there is a disclosure in the 10Q that Tesla has received requests from the Department of Justice for documents related to Tesla's Autopilot and FSD features. They say that, to their knowledge, no government agency in any ongoing investigation has found any wrongdoing from Tesla. But the larger point that I want to make here is that this is not a new disclosure from Tesla. This same paragraph, verbatim, exists in the 10K. We've already talked about this before. Just helpful as people like to look through those disclosures and write new articles about them every time. All right, moving on from the 10Q, we've got some reporting on Tesla's market share for California. However, it is for EV market share. If we look at the numbers here, we can see that Tesla's got a 60% share of BEVs in the first quarter, with about 57,000 vehicles sold. Now, obviously 60% market share in any market is a great number, but because that is down a little bit from Tesla's market share in 2022, which was 73%. Of course, there is a lot of reporting on that. But again, just reiterating, this is EV market share only, which is really not a very good measure of much of anything, especially when there is a market that is so heavily dominated by one player like Tesla has in California. Over 2 years ago, on the March 3rd, 2021 episode of Tesla Daily, I did an episode on why this would not be a very good metric to look at and why we'd probably see stuff like this going forward for many years. It's almost a mathematical impossibility not to. So I'll put the example that we walked through. I won't go through everything here. You can just watch that episode, which I'll link in the description. But basically, to retain those high market shares, Tesla would have to grow capacity at that same market share ratio versus everyone else. So if you're at 80% market share, you have to grow your capacity 4 times everyone else's combined capacity growth. Hopefully I don't have to spend too much time explaining why that's pretty much impossible. And that's why car market share overall is much more important, because as these others add capacity for EVs, well, they're probably just siphoning off sales from their ICE vehicle business line. Tesla's not looking for 60% forever. They're looking for 20-25% of the vehicle market. Yeah, obviously market share for EVs probably going to decline. All right, last couple of things. We've got a somewhat rare update on Tesla's factory in New York. Of course, they have things like Supercharger production there, solar production. They've got an autopilot labeling team. But according to new filings, Tesla is looking to spend $3.5 million to build a 570-space parking lot near the facility. So hopefully, and probably a sign of Tesla continuing to expand operations there in New York. Last item then, kind of an interesting note from Adam Jonas of Morgan Stanley today. They have done a couple of polls of some of their clients regarding the current sentiment around Tesla stock. Jonas says, quote, Tesla's Q1 earnings didn't so much reignite the bull-bear debate, but seemed to shift sentiment far more to the one-sided negative. Since earnings were released, we have fielded questions about Tesla's pricing strategy, asking whether we are witnessing a strategic masterstroke or a potential blunder that threatens Tesla's long-term profitability and brand strength. This past Thursday, we hosted a bull-bear lunch in New York City. At the start of the lunch, we asked the 36 attendees via show of hands who believed Tesla's share price would outperform the stock market over the next 6 months. Not a single hand went up. It should have been called a bear lunch, end quote. Additionally, Jonas said they sent an email survey out on Friday and 44 people had responded. 71% of those said that Tesla would underperform the next 6 months. So this is exactly what I said at the beginning of Thursday's episode. Tesla is not communicating things that are going to make Wall Street very excited for that 6-month time period, which is predominantly the focus. So it could be a bumpy time for the stock with that sort of sentiment overwhelmingly prevailing, but hopefully that can mean that the bar is relatively low for Tesla for that period of time. All right, that is where we'll wrap it up for today then. As always, thank you for listening. Make sure you're subscribed and signed up for notifications. You can also find me on Twitter at Tesla Podcast, and we'll see you tomorrow for the Tuesday, April 25th episode of Tesla Daily. Thank you.